All right, so we're digging into these leverage stocks slash ETFs and ETNs, and explaining how these things trade and how you should use them, and how you, if you're trading options, what you should be doing in these products, because it's a little bit contrary to our normal trade setup. So with all these leverage products, they all have some sort of drag or drift component to them. So if you see anything that has tracks 1x, 2x, 3x to any sort of product, whether it be volatility or oil or natural gas, all those products have some sort of drag or drift component to them, which, when you're looking at like volatility and oil and natural gas, stuff like that, that can be a significant part of these products, right? So with TQQQ or SQQQ, those products, the drag on that is very, very small. When you look at something like volatility, you can have 2, 3, 4 points of contango, which is going to drag, is a 10 or 15 or 20% just drag on those products. So you have to keep this in mind when you're looking at these products, that they will have an influence from those futures contracts, which they have to continuously roll, and there's a cost to do so when you're rolling out in the future if the prices are in contango or backwardation. It depends on there. So net there's going to be, and there's your net of the day, there's going to be a cost associated with these products that is baked into the price and movement of these products. So I listed on the left side some of the more common ones. I don't know if there's any gold or silver ones anymore. I remember there was like JNUG and something else, but if you got a gold one, put it in the chat, and I'll post it here on the slides when we archive them. So for these positions, they're short-term trading vehicles. You can't inventory these products. If you look at a long-term chart of UVXY or Boyle or, SQQQ, even TQQQ, these products drift down, and ultimately there's, reverse splits, and these products, when you look at a chart, they've never actually traded that value. It's just due to the drag component, because these products would be zero if they didn't do any sort of splits. So those prices aren't real, and we'll look at those on the next slide here of UVXY, which is the one we typically show. These prices never got to that point. Yep,
and really the too long didn't read version of this is, if you're trading a new product, if you think it's leverage or you're just trading a new product, just do a quick Google or Bing search for it and look at the fund summary, or look at the makeup of it. And if it says this product seeks to replicate the return of XYZ futures, then it will be subject to drag or drift.
Yeah, and it'll tell you, all of them will say this is not made for long-term investing, and that over a period of time, the returns aren't going to match whatever it's tracking. And we're going to look at that as well, just to give you some expectations. So here's UVXY. Obviously, UVXY was never trading at 20 million or 18 million, whatever that top. I am 100% sure it was never trading at that point. It will never get back to that point. It's impossible, unless there was some, I won't say impossible, because I guess it could potentially happen, but probably not 18 million. We'll cap it at a couple hundred. But the reason why it drags like this, and why it goes to zero, and why the chart for all these products will look like this, is because the futures roll, right? So if we're looking at the Z contract and volatility, and UVXY is actually a basket, it's around 60-40, so 60% in the front, 40% in the back. But just to make it easy, we'll just say it's all in the front right now. If you were rolling from the Z contract to the F contract, meaning you're the ETF holder here, you have to sell out of the 21 volatility and buy the 23.97 volatility, right? So there's 2 points, or $2.50, we'll just round it, 10-15% of the asset's price in cost to roll that future. And that value, that loss of value, which it doesn't matter what happens with volatility moving forward, there's going to be that cost associated with it. And so if all else equal, if volatility stayed, flat for the next year, this product would go to zero because every single month you'd have to pay that 1, 2, 3 point difference in the price of those futures.
Yes. And if that's a little confusing, just the concept of it, just think of like having a fixed amount. So if you have $1 million in the Z contract and you're selling out of Z, buying F, however many shares, if you will, or whatever the exposure was, it's going to be less. And that's how it gets down to zero, because as you're selling out of a lower price, buying a higher price, you can't have the same exposure because the prices are different. And that's why this drag is in effect when the volatility futures are in contango, where the near-term cycles are less expensive than the further dated cycles.
Exactly. And you could even dumb it down a little bit further from there and say, if you had 5 shares of VX here at 21 and now you got to roll to, a product that's now $24, you only have 4 shares now, and then further and further down the line until you get to basically zero, and then the product splits so that it becomes tradable again, right? So when somebody gets down to $7, it's hard to trade that product. The liquidity isn't the same to hedge a position. It's not the same notional, right? So if you're trying to hedge $10 and you're using UVXY at 7, you need 50 shares. Whereas when it's at 70, you'd only need 5 shares. And so that kind of comes into play, and that's why these products split. So with all these products, you'll see a lot of skew on one of the sides. And so if these are bearish products, you'll have call skew. If they're bullish, you'll have put skew. And that's because of the velocity of risk of these products. So volatility, which is bearish, but you're getting long it, is going to have call skew because the moves to the upside in volatility are much greater than the slow grinds to the downside. Something like TQQQ will have put skew because it's a 3 times bullish product. So the move is to the downside, the bigger move is to the downside. So this means that the easy trade, meaning playing to the side that this is skewed towards. So if you're, trading UVXY, like selling puts in UVXY, if you're looking at oil, selling calls or call spreads, the easy trade is the cheaper value with more risk. So if you look at like UVXY, selling a $2 wide or $3 wide put spread is going to net you the same amount of credit as selling a $5 or $10 wide call spread. And that's because the easy trade is to the downside. There's, volatility tends to go down, and, it has this drag component. It's structured to go to zero. When you look at the chart, the easiest trade would just be to short UVXY, right? Well, you have the velocity of risk to the upside. And so it's cheaper to play to the downside. You'll have more risk to the skewed side. So when you're looking at these products to trade them, they're really best suited for that YOLO type trade. Buying some calls in something, like a UVXY where the velocity of risk is to the upside. Those calls are going to move a lot more than than selling puts will, because of the dynamics of these products and because of the volatility of these products themselves. So the puts, like if you're selling puts in UVXY, the decay component on those puts is offset by the velocity, the change in volatility of these products. So when volatility expands, volatility expands as well. So if you're short premium, even if you've got long delta via like short puts, the amount that you get paid on that directional move is going to be far less than what you would expect it to be given your delta at the start. And that's because the distribution and the extrinsic value increases across the board on all those products.
Yep. And it's very similar to, when GME and AMC crash, it's pretty much the opposite. But really, when it comes to trading these volatility products, that's why when we're trading them usually with a debit trade to the upside because of volatility and how when these products increase, the volatility of these products also increase. So we're strategizing for the fact that we know this to be true and how this is different for your standard equity.
Yeah. And then the last point to make here is that you have to consider the percentage move of these products, right? So they don't move based on the value change. It's the percentage change. So when you look at something like UVXY that moves 1.5 times the daily change of volatility, that 1 point is not the same when the VIX futures are at 20 versus when they're at 30. Those are different values on these products. So it's not the exact same thing. You have to keep that in mind, that 1 point move in volatility is not the same when volatility is low versus when volatility is high.
Yep. And that's why we really haven't been trading these all too much, because volatility has been in the high 20s, and percentage changes if the futures go up 2 or 3 points, it's really not that big of a percentage change. But if volatility gets back into the teens, especially the low teens, then now all of a sudden a 2 or 3 point move in volatility is a 30% change in these products.
Yep. All right, then getting on to the last point here, and this was, what I was trying to get at in the beginning of, even though a product is structured to move, in a greater magnitude than whatever it's tracking. So here we're looking at TQQQ, which is 3 times whatever the Qs are on a daily move. Over a long period of time, that the movement isn't the same, right? So over this 2-month period, we've had the Qs go up 5% net. TQQQ has gone up about 10%, and that's because of the velocity of the movements and the bigger movements to the downside over a longer period of time. And this will get even more in line as you look on a further out time horizon, especially if you see bigger moves to the downside within that time frame. So if you look at this over the last couple years, even though the Nasdaq is still significantly higher than where we started, TQQQ has gone down. Like that's these products in a nutshell, is that over a long period of time, the percentage movements are not the same.
Right. And that's why when you're looking at this chart here, I think the big thing to focus on is like when the Qs are kind of flat to down, that's when this just really drags. Same thing here, like right here where it's kind of flat. You're seeing a big reduction in price here with TQQQ. But when there's a really big spike in 1 or 2 days, that's when this thing explodes. So this explains why we don't trade them long term, but they can be really effective for short term trades if you get the timing right, et cetera, et cetera. But just like holding on to these, you should expect to see underperformance because of the fact that these have to rebalance and the leverage is kind of dissipated when they do.
Yeah.